Welcome to the Explainer. Okay, today we are diving into a literal masterclass in portfolio strategy. We're going to evaluate 10 real-world stocks, but listen, we aren't just looking at them as random stock tips or speculative gambles, no way. Instead, we're putting them through a really strict analytical framework to truly understand their risk-to-reward ratio. By the end of this, I promise you're going to have a completely new lens for looking at the stock market. Let's get right into it.
Okay, so here's our roadmap for today. We'll start with the value investing quadrant, then compare high risk versus safe bets, look at fair companies trading at attractive prices, break down the Amazon growth engine, and finally wrap up with cyclical markets and strategies.
All right, part one, the value investing quadrant.
So, I want you to picture a physical four-square grid in your head. This is the value investing quadrant. On the x-axis, running left to right, we have our potential reward, scaling from a really low upside all the way up to incredibly high returns. But on the y-axis, running vertically, we measure risk. Here's the thing. Every single investment you make absolutely has to be plotted on this map. You literally cannot look at the potential upside on the x-axis without heavily weighing the inherent danger level on the y-axis. Now, the goal isn't always to find zero-risk investments, because let's face it, those barely exist, but to make sure the risk perfectly matches your specific strategy and the reward you're actually getting in exchange.
Moving right along to section 2, high risk versus safe bets. And these two companies brilliantly illustrate the extreme opposite ends of our quadrant. First, look at Charter Communications. After their merger, they are sitting on a terrifying $120 billion debt pile. That is 5 times their EBITDA. If revenues decline or free cash flow drops or interest rates just tick up, this thing could genuinely go to zero. But, and it's a big but, if they navigate it perfectly, you could see a 3 to 5 times upside. It's the ultimate asymmetrical, super high-risk bet. Now, contrast that with Fiserv. This is a deeply entrenched investment-grade business. Their debt is way more manageable, sitting at roughly 2.5 times EBITDA, so the risk here is significantly lower. Sure, you're not going to get a crazy 5x return, but you are looking at a much steadier, highly probable 12% return. Two totally different stocks living in two entirely different zip codes on our quadrant.
Which brings us to section 3, fair companies, attractive prices.
There's this classic philosophical dilemma in investing. Is this a wonderful company at a fair price or a fair company at a wonderful price? Naturally, we'd all love the wonderful company at a wonderful price, right? But the market rarely just hands us that. So the next few stocks we're going to look at fall perfectly into that second bucket. They're what you'd call fair companies, but right now, they're sitting at truly wonderful prices.
Okay, let's rapid fire through how these fair companies actually look on our metrics. First up, we have HP. Now, printing might be a declining business long term. That's the risk. But wait, they're generating $3 billion in free cash flow, paying out solid dividends, and even catching a recent boost from AI computer demand. You're actually looking at a potential 30 to 50% upside there. Next is Domino's Pizza. Their stock price literally crashed from nearly $500 down to under $200. That gives it a really juicy 6% dividend yield. But here's the key takeaway. They're still seeing 5.8% growth in total orders. The fundamental business hasn't broken down at all. Finally, look at Nomad Foods. They're down 66%, trading at a low PE of just 10. The really fascinating signal here, the CEO just spent $1.5 million of his own cash buying up shares. You got to keep your eye on the y-axis, though, because they carry $2.2 billion in debt. For a private label food brand in a high-rate environment, that's a massive risk you have to factor in.
Now, I absolutely love this one, because we spend so much time doing this hyper-complex analysis on billion-dollar tech platforms, and yet right here on our quadrant sits Greggs, the humble UK bakery chain. Despite all the wild economic noise out there, people still need to eat, right? Greggs is posting 7.5% sales growth, yielding a solid 4% dividend, and proving that sometimes the most stable and highly profitable investments in your entire portfolio are literally just really good sausages. It's a fantastic real-world example of a low-anxiety, steady reward play.
All right, section 4, the Amazon growth engine.
Now, what's really interesting here is the absolute paradox of Amazon's cash flow. If you only glanced at their bottom line, you'd see their free cash flow is practically zero. Normally, that screams high risk, right? But you have to translate what that zero actually means in this context. It's not a failure of the business at all. It's a deliberate, hyper-aggressive choice. See, Amazon has massive and growing operating income, but they are literally taking nearly $100 billion of it and funneling it straight into massive capital expenditures, primarily AWS data centers. They're actively starving their free cash flow today just so they can entirely dominate the digital infrastructure of the future.
But hold on, before we go declaring Amazon a flawless victory, we really have to look at this frankly staggering number, $28 billion. That represents just a 1% yearly share dilution. So why does that matter? Well, because Amazon uses those shares to aggressively compensate their managers. And for a company of this sheer size, a 1% dilution forces them to effectively spend $28 billion buying back shares just to keep things level. That eats up a whopping 25% of their net income. It's a really crucial hidden cost that definitely slides Amazon slightly higher up on the risk y-axis than a lot of investors probably realize.
Just briefly, let's touch on Adyen, the Dutch payment system, as another example of a tech growth play. Their stock took a pretty big hit, but they're still delivering 20% constant currency growth and are deploying $750 million into acquisitions. Assuming the European payment ecosystem avoids a really severe recession, Adyen actually sits in a very compelling spot on the quadrant. It offers some really solid potential returns for those investors willing to weather a bit of short-term market disappointment.
And finally, Section 5, Cyclical Markets and Strategies. So here we have the cycle of Cal-Maine Foods. They're a massive egg producer, and this perfectly illustrates how to play cyclical markets. The golden rule of cyclicals is actually totally backward to human nature. You see, you buy when the situation is incredibly ugly and prices are low. You don't buy when everyone is out there celebrating boom times. Right now, egg prices are low, sentiment is bad, and margins are normalizing after a period of huge inflation-driven profits. So on our quadrant, the time to actually take the risk is now, right here at step 1, as we wait for the cycle to inevitably turn back to step 3 over the coming years.
So the crucial point is how you actually physically manage that kind of volatility in your portfolio. And that brings us to our last example, the China Technology Internet ETF. Look, it's down 30% over the last 6 months. It's battered. But it gives you direct exposure to absolute giants like Tencent and Alibaba. And historically, this sector experiences massive booms every 5 to 7 years. Now, because the risk here is undeniably high due to geopolitics and regulations, this is a pure strategy exposure play. You absolutely do not go all in. Instead, you dynamically scale. You might set a base allocation at, say, 5%. If the price drops further, you bump it to 7% to capture the upside. If it recovers, you trim it back. The trick is you're trading around the volatility rather than just crossing your fingers and hoping it goes up.
Okay, we have covered a ton of ground today. Everything from terrifying corporate debt piles and highly profitable sausages to the hidden costs of Amazon's data centers and the totally counterintuitive logic of cyclical egg markets. Every single one of these examples presents a completely different balance of danger and potential. So I want to leave you with this final provocative thought. If you plotted every single investment you currently own onto that X and Y axis right this second, are you actually getting the reward you deserve for the risk you're taking? Think about it. Thank you so much for joining me for this explainer, and I will see you next time.